A new monetary system is coming, and sooner than you think. I'm your host, Steven Van Metre, and thanks for joining me today. Monetary plumbing expert Zoltan Poszar is saying that a Bretton Woods III agreement is coming, and perhaps even sooner than you think. But is he right or wrong? And what does all this have to do with dollar and what's going on with Treasury yields right now? Let's pick the story up where we head over to Bloomberg, who headlines that Zoltan Poszar sees a world of problems that money can't solve. Welcome to Bretton Woods III. And this is just an example with a new economic order that Zoltan Poszar, global head of short-term interest rate strategy at Credit Suisse, has characterized as Bretton Woods III. And in a recent interview, he's been focusing on this flip from problems that can be solved with money to those that can't. What's interesting, a lot of people think they got a lot of problems, many of them which can be solved by money, but Zoltan says, nah, some of these, they can't. Let's continue on because indeed of a Volcker moment. Now, what is he referring to here? He's referring back to the 1970s when we had that period of high inflation, and he's trying to draw that parallel. So keep in mind, and even though there really isn't a strong parallel, keep in mind that's what he's trying to do is connect the dots here to the inflation of the 70s and what's going on now. We've got a Putin moment, and we basically have a war, and out of this war, something will also emerge. Out of this, I think Bretton Woods III that I've started to kind of develop and run with is a world where we are again going back to a commodity-backed money. Now, keep in mind, Bretton Woods came out of World War II, so the notion that it's from a period of high inflation, well, not so much, but perhaps maybe we'll give him some latitude. We'll continue down this story and see if he's right or if he's just way ahead of himself. And where gold, once again, is going to play a big role, and not just gold, but he thinks all forms of commodities. Now, what's interesting is the same reason we went off gold is a reason we are not going to go back on it. It just doesn't work. There are limitations if you study the history of monetary policy where what gold does, it doesn't work because it cannot expand. And for that same reason, many people think that Bitcoin or other cryptocurrencies are going to take over that role. But for the same reason gold doesn't work, they don't work either. So, Zoltan, I don't think we're going back to gold anytime soon. But let's continue on because most shocks we've seen prior to recently, at least for rich countries, have fallen into the first three buckets. He said the U.S. banking crisis, for instance, was all about par. Is $1 in a bank account or a money market fund really worth $1? And that was a legitimate question because you may remember when the money market funds broke during the financial crisis, that people actually were wondering if $1 is indeed $1. So there's a valid point there. Meanwhile, the Asian financial crisis reverberated through the currency markets. But now we have something new, he says, a shock to the price level. And to the above four prices of money, Poszar adds three more to his new framework. And while the first four prices are all nominal, meaning they're measured in terms of money, the next three are real, meaning their inflation number adjusted. They're all about actual goods and services, and he's referring to foreign cargo, shipping, and protection. And I want you to keep those three in mind, and we'll probably have to come back to that real quick. In this world of non-monetary stresses, these are the new key price measures to watch, he says. In this new world, anyone wanting to get a handle on the future direction of the economy will have to watch these factors carefully. Short-term interest rate traders, for instance, will need to know about shipping if they want to figure out whether liquidity is increasing or diminishing. And now let's go back and apply that test to what actually happens now and see what he's even referring to. So check this out. So do we track foreign cargo flows? Yes, we do. Do we track shipping rates? Yes, we do. Do countries like the United States, for example, send their navies out to protect cargo lanes? Yes, we do. All these things are happening now. And we use that data to determine what's going on with the global economy. Because when we see periods of inflation, we see cargo amounts rising, we see prices rising, and what does that tell us about the global economy? Yeah, it's expanding, and those are usually good things. In fact, we have data right here from the Federal Reserve St. Louis database that we look at a lot, and here we can see import prices into the U.S. And while that tells us, you can see that when import prices slow, usually that means the global economy is slow. And you see back here in the late 90s, and then during the dot-com bubble, and then during the global financial crisis, and then going in 2015 where prices came down, and then we see going into the pandemic, we knew we were headed into recession, and now they're headed higher. But for how long? Because based on the design of the system, these price shocks don't last anymore. That's the problem. They can persist for a while, but then they go away. Let's continue on and see where Zoltan's going with this, because when you think about how reserves move around the money markets, now if you don't know what a bank reserve is, if you deposit money in a commercial bank, what they do is they back that with the U.S. Treasury or mortgage-backed security in the event that they cannot lend against it. And that act of creating or taking a customer deposit and purchasing a Treasury or mortgage-backed security is called creating a bank reserve. So that's what he's referring to, bank reserves here. Let's go back. He says, when we think about how reserves move around the money markets, now what does he mean by move around the money market? So let's pretend I have a bank account at, say, Bank of America and another one at JP Morgan Chase, and I transfer money from one bank to the other. Well, physical cash isn't moving. What happens is at the end of the night, the Federal Reserve nets out all the transactions between all the commercial banks and says, okay, maybe in this case, B of A, you actually owe JP Morgan some money, and reserves get transferred, not cash, reserves, and then banks adjust their balance sheets accordingly, so they're netted out all the numbers. So that's how the system works now. He says you always need balance sheets for some banks to borrow here and lend there and harvest some funding spread. In a world of physical commodities, a balance sheet is basically a ship. You load cargo in port A and you bring it to port B. The cargo is not money, it's a commodity, but you encumber capacity to move stuff around. And I'm going to challenge that a bit, because we do know what's sitting on a ship is indeed cargo. There's no mystery about that. If you have, say, a ship full of cars coming, say, out of Asia to the U.S., it's got cargo on it. It's got goods, things that are useful. And what happens when that ship gets unloaded? What do they get paid in? Dollars, currency. So the idea that perhaps maybe ships are going to show up and get swapped with some other commodity, I don't quite think that's going to happen, but people want to get paid. The people carrying that cargo, you know what they think of it is? They think of it as in currency, in dollars, what it's worth. So this is a new framework, he says. Instead of central banks guaranteeing that your money in the bank is actually good, it's the world's militaries guaranteeing the cargo on your ship will actually get to its destination as advertised. And doesn't that happen now? You bet it does. It happens every day thanks to countries like the United States and the people that serve in our Navy and have served in our Navy, guaranteeing our waterways, and other countries who do the same things. And to Poszar, this is also a world which, yes, the dollar's centrality with the global economy starts to fade, and Russia wants to sell gas in rubles. Saudi Arabia may start selling oil in China and yuan. A less globalized system for trading commodities may result in greater monetary diversity with different trade routes denominated differently. And guess what? That happens now too. So not everyone trades everything in dollars. They trade in other currencies, euro, yens, rubles. Trade happens in all currencies all day long. There is just one predominant currency that everyone looks to for its stability and the value of it, and that is the dollar, and they look toward that being backed by the U.S. government and the Federal Reserve. So all these things are happening now. So it kind of makes you wonder, is Poszar just describing our current system? Let's continue on, because there are other consequences as well. He says countries will be more inclined to stockpile commodities in the new regime, and that, I will say to this, is they're going to anyways, because after our lessons we learned in the pandemic, you bet people are going to stockpile commodities, especially food stocks. I guarantee you that's going to happen. You don't even have to be an expert for that. So inflation will be higher, he says, from this piece on Zero Hedge. The level of rates will be higher too. Demand for commodity reserves will be higher, which will naturally replace demand for foreign currency reserves, particularly U.S. Treasuries. Meanwhile, demand for dollars will be lower as more trade will be done in other currencies, and that is absolutely incorrect. Because in the end of the day, and a lot of people do not understand how the system works, is when you trade with countries like the United States, and being we are the world's largest importer, think China's world's largest exporter. So when you do business with the United States and you import your goods here, how are you getting paid? Are you getting paid in yuan? Nope. Euros? Nope. Yen? Nope. Rubles? Nope. Go down the list. There's one currency you get paid in, and that's dollars. And that's why there's a demand for dollars in the system. And why is there a demand for treasuries? Because when people get too many dollars in their country, they put their savings in U.S. Treasuries, because when they need dollars, they access those Treasury savings. This is what we learned from our buddy Jeff Snyder, who is also, and maybe more so, an expert in the system than Zoltan is. But that's how the system works. That's why the dollar's not going away, and that's why strategies like Portfolio Shield work so well at hedging downside risk. And if you haven't checked it out, I'll put a link up here in the corner. Be sure to check it out sometime. You'll be glad you did. Now let's continue on with the story, because here you can see just how these demand for U.S. Treasuries from trade wars. And we see here in blue federal debt held by foreign and international investors in blue on a year-over-year rate of change. And we've got the consumer price index on red in the year-over-year rate of change. So what happens is when prices rise in the U.S. and with a lag, because it takes time to get goods produced and shipped over here, what happens, you'll notice that federal debt or treasuries held by international and foreign investors rises, because what are they doing? They're taking their low-cost produced goods and saying, hey, way over there in that country, we can sell this for a lot more money than we can sell anywhere else. So they start shipping and producing goods and flooding the U.S. market with it, and that's what happens during inflation. And when they get those dollars that come flying back through due to trade, well, they store them in U.S. Treasuries. And that's why you see in this relationship here, the periods with high inflation are met by rising demand for Treasury securities. And here we see it now. The only difference is no one thinks that anyone's going to buy them. But the difference is foreign investors aren't sensitive to changes in interest rates. They're literally buying and holding them to maturity as part of their savings plan. No different than you might hold some money in your bank for savings. You don't worry about what rate it's paying. You worry about it being there when you need it, and that's the U.S. Treasury market. And so translation, the dollar is on its way out as the world's undisputed reserve currency. Well, I'm going to tell you, Zoltan, that is not going to happen, because when you are the world's largest importer, you get to demand how people get paid, or they don't do business with you. And until that changes, the dollar is still going to be in charge. Let's continue on. Because China ranks as the biggest foreign holder of the view of debt, if it continues to divest itself of dollars, who will pick up the slack? Well, simple. Some other country that wants to trade with the United States, that wants to build an export base and trade with the United States. It's that simple. If China doesn't want to trade with the U.S., they would divest themselves with dollars. That's what they would do. And guess what? Their whole economy is going to go down, because their economy is built on exporting to the United States. It is when you start to see it and understand it, it makes perfect sense. Even if this is nothing but talk, it underscores the fact that the dollar is on shaky ground. Well, no, sir, because if it was, you notice here's a historical chart of the dollar, and it doesn't appear to be on any shaking ground. In fact, it's appreciating in value, just as the system is designed to do. Now, what does all this have to do with what's going on with the dollar and bonds? Because there is a big question now, is why is the dollar rising? Why are interest rates rising? Bond prices falling? What's going on here is because a lot of people don't understand, when the dollar goes up, it means financial conditions are tightening. Now, normally when rates fall or rates rise, because of what's going on now, it means financial conditions are easing. But when rates rise, this is something that took me a long time to understand, but when you get it, it makes sense. When rates rise and lending demand declines because people do not want to borrow at higher rates, well, it means financial conditions are tightening. There's only one way to break the dollar of its ascent, and that is lower rates. And let me show you here on this chart, and this is from my trading software, so I know the colors aren't that great, but here you can see in purple the dollar rising. Here you can see bond prices falling, and what happens is, in order to break the strength of the dollar, see it comes down here, what happens is the bond prices, they have to go up, interest rates have to go down. Now, normally they're fairly well in sync, but again, there are periods here, dollar rising, people think, oh, that will sell bonds, and next thing you know, bonds go shooting up, and finally the dollar weakens. Now, there are times where bond prices go down and the dollar weakens because the economy is doing well, but this is not one of them. In fact, we have this big gap here that will either be met with the dollar going higher, and then, of course, in order to break it, because the Fed is tightening monetary policy, rates will indeed have to fall. And you can see another event here where the dollar was rising. Again, people were selling bonds, driving rates up, and all of a sudden that broke. And what happened? You see interest rates absolutely collapse lower, because that's how the system works. And so, are we on any precipice of a Bretton Woods III? Not even close. Is all the things that Zoltan explained more about how the system works today? Yes. We're not going to a commodity-backed system. We're not going to a gold-backed system. We're not going to a Bitcoin-backed system. If anything we go to, we'll plant this seed with you, we're going to a reserve-backed system the dollar isn't the reserve, but U.S. Treasuries are. We'll leave that to blow your mind. I'm Steve Van Metre. Hey, thanks for being fans. Thanks for watching. Bye now.